Good morning, traders. I'll make this quick and short. I just recorded the video and for some reason it didn't record. I don't know what happened. So take two, Mach 10. Markets, not a whole lot has changed. We have been in an oversold condition just a few sessions ago. We poked up to a bit of an overbought. The market is set to gap higher, right back into resistance from yesterday. Likely going to see some FOMO. Let's just touch on the intraday chart here. Let's just take a look at the 10-minute chart. Now we have some, let me just go to the SPY. This will be the best one to look at. So the SPY is showing us a few things. I've already drawn on this a minute ago with the video. Let me redraw it for you. But we have price spikes that happen in the market. We talk about these when we have a pre-market spike. The market generally wants to run to fill most of that spike. We had a spike down 2 days ago and pre-market came down, filled that spike. These are very short-term day trades. It's not something we focus on, but it allows us to know what to expect with price in the very near term. Now, in the past 2 sessions ago, we saw a big rally up. It chopped around and then huge selling to the downside. We are back into the same scenario, the market running right up into resistance. It's running up in pre and post market last night and this morning. Looks like it's trying to put in a top. Usually what goes right up and gaps into resistance, these big price gaps tend to fill. As we know, gaps get filled on the indices in most cases. We also have this giant price spike telling us and warning us that for some reason the market maker or the market is going to want to come all the way down and fill that gap. So the fact that we're opening up at resistance, we're probably going to see one of these big, heavy volume selling institutions step in and they unload their portfolio in a blink of an eye and they just dump their shares. And they're trying to unload and reduce their risk and exposure. And there's a few things telling us that. The VIX is telling us that. So let's go take a look at the VIX real quick. The VIX, the volatility index, the fear in the market. This is telling us that, hey, we're bouncing bottom here. We don't have a whole lot of fear. If we zoom out, when the VIX is low, it's time to go. Now, it doesn't mean you sell your position. It doesn't mean you bet on a falling market. You just need to know at any point here, the VIX is going to spike because there's going to be a drop in the market and people are going to panic. And that is that's what the VIX shows us. So we just need to be aware that things are getting... right now, people are piling into the small cap stocks. The Russell is up significantly today where the NASDAQ is flat. Technology is struggling. Money's moving into the riskier stocks. They are also buying call options. And what happens when the VIX is low like this, people start to buy the more risky stocks because they're bullish. They're not fearful at all. The VIX is low. And they want to make more money. And usually after they've bought most of their stocks that they're going to buy, they go to the options market with the rest of their account. They'll have a little bit of money laying left over. And so what they do is they buy call options. So let's just clean up this chart. We'll look at the moving averages. And I like the 5-day moving average. And whenever the put call ratio on average gets down into this zone, we usually tend to see the stock market stall out and start to have a bit of a pullback. And so people are buying call options and then we eventually see this spike up and they start to buy put options. And this is usually because the stock market falls and then suddenly they're like, oh, well, I'm going to bet on a falling market now. And then, of course, it goes the opposite direction. The market rebounds and their puts go worthless. So it's just a ping pong. Options, if you buy calls and buy puts, it is a very difficult strategy. Don't recommend it. Definitely need to be selling options and writing options, which is what we actually do at Technical Traders with our options trading newsletter. But this is telling us where we are right now. People are buying leverage because they want to make even more. And so it's either they're buying leverage or they're not in the markets right now. They missed out on the rally and they have a lot of FOMO. And that's kind of the phase that we are in at the moment. Now, these moving averages, they're all in the book. Just in case I have mentioned, we've just updated the book, Technical Trading Mastery. If you go to Amazon, you can get it there. We're updating the cover, but the cover will be updated, but the book is already updated. If you were to buy it, you'll get the new inside of the book, which has all of our how to identify which moving averages we use, how to use them. And then, of course, we go into, for example, like the 30-minute chart here provides all the details for both the daily and the 30-minute chart, how to set up these charts exactly like more or less what I have, where we have the panic selling indicator, the FOMO indicator. We have these oversold. We'll have the overbought indicators when the market is bouncing higher. and it'll tell us when it's overbought, all of this stuff, and how to identify the trend. When is the trend more so green, up, or red, down? All of that stuff, and how you can go about trading that. So that is in the book. If you were to purchase it, it's updated. It's updated in the chapters, and in the back of the book, all the details and the settings for exactly what to put, the values and all of that. Anyway, looking at the markets, let's see where else money is flowing. We are having money go into stocks, moving out of bonds today. Bonds have had a bit of a bounce. Let's just zoom in on this chart here. Bonds have had a bit of a bounce. They're back up. In the grand scheme of things, they are clearly in a downtrend, so we're not interested in bonds. What is interesting is utilities are really on fire. They're taking off. They've built this launch pad. They're pushing higher. And when utilities dramatically outperform the S&P 500 and the NASDAQ, it is a red sign, a red flag, a warning. And it's starting to really pick up speed. So we'll have to be aware of what's going on here. Usually this can outperform. It can outperform for several days, even in some cases a week or two. And then suddenly the stock market puts in a significant top and utilities will get hit with it. But all it is kind of a warning sign. I know we did talk about XLY. I know a bunch of you took this when I talked about this trade setup right here. Let's just pull it out here. So we had this rally up, this bull flag pattern. We talked about it on this breakout day, saying, hey, this looks like it has potential to keep moving up. There are a few levels. It is moving very slowly. This is a very conservative play. It's moving up slow and steady, but it is continuing to grind higher. And let's just see. So it does have potential to keep pushing up to this 232, which really would be, I think, it has potential to go a whole lot higher. I don't see that happening. I see this golden ratio, the 618, coming into previous highs. That will probably be the maximum. I'd be starting to get pretty happy and tightening up stops if you were in this. This was just a discretionary trade, a side trade I mentioned. I didn't put it on. I'm just saying I do like it, and I know a bunch of you took it, so I'm just giving you a bit of guidance into. I don't know what it's up. It's a slow moving percentage. I think it's only a couple percent or so. You should have got in somewhere at the open the next day, which would be over here. So it's only up like 3%. It's not much, but just be aware. This market, once it does roll over, this will just come right back down very quickly. So it's about squeezing money out of these nice high probability trades. It's not about making a lot on them, but it's about making money and inching our way up. A bunch of first base hits compounded in our account every year adds up. You don't need to hit a ton of grand slams and take a bunch of risk. So what else do we have? Let's take a look at ITA. I forgot to add this. Our last mentoring session, a member asked if we could put in the aerospace and defense ETF, which I have now put it in. It'll be here. He had a very nice trade on it, got in, and he actually sold it somewhere around 193, I think, which actually long-term on the weekly chart is the Fibonacci target. So he kind of nailed that. In terms of the performance, it's done pretty well since our entry price. It's up about 19-20%. All of our other band trades hit their targets as well. We hit two of them hit the 20% target. So this is in line with the other trades that we've done. We did the IBIT and URA. They have done very well. So anyways, we do have the aerospace defense ETF in here going forward for a potential opportunity. When we look at the top of the list here of all of these sectors, they are all the wild ones. We've got silver miners, the ARC, lithium, marijuana, uranium, clean tech, and all that stuff. So again, money is flowing into these. That's why the small caps are doing really well. Somebody wants to talk about lithium. Let's just take a quick peek. Lithium is popping, really screaming higher. I'm not a big fan of the overall chart. It's clearly still in a downtrend. Now the 150-day moving average here is starting to flatline, so maybe it's trying to put in a bottom. But when you see these big pops and hooks to the upside, like they're standout highs, pretty much they're usually followed by some pretty big selling. So I would be very, very protective of my position. I wouldn't. I know most people get into these expecting them to go up here. They're in love with the sector or whatever it is they're trading. They believe and they want the biggest price. But usually when you have these really clear, like you could give this to a fifth grader and you'd be like, what do you think the next thing is going to do based on history, price action? They're going to be like, oh, it's going to go straight up. It's going to come straight back down. So always be happy to lock in gains. You can always get back in later. It doesn't matter if it's at a higher price. Right now, at best, it is going sideways or it's still in a downtrend and it's going to get sold into. So Remember, pull money off when you can. You can always get back in when there's a fresh new setup. And again, the stock market is very close to pulling back, which means this will pull back with it. The stock market tide, when it goes down, pulls all of these sectors down in most cases. What else do we have? Few people want to look at platinum. Platinum has been on fire. I covered this not too long ago, but overall, if we just take a look at this, it is doing a running correction to the upside. Running corrections are very, very dangerous, high volatility. You have no idea which way they're going to break. They can go for a long time, but typically when the stock market trades and it goes up, and then it usually creates a bull flag. It flags sideways and then has the second half of the move. What platinum is doing, and there's obviously some shift or news or event that's really triggering a big part of this, but it's had the run up. And instead of flagging down, it's actually having a running correction, meaning it's channeling to the upside. And it has a sharp drop and then a strong pop. And this volatility, these huge back and forth day swings, are enough to shake people up. So instead of pulling back and correcting and shaking traders out before going higher, it's actually shaking them up, shaking them out as it's moving up. And it constantly looks like it's going to reverse and sell off. So it gets them out and then it pushes higher and then it does another reversal bar. Looks like it's putting in a triple top. It's going to crash, but then it goes higher. So it's shaking people out with a fearful pattern. And at any point, this is the problem with this pattern, is it can shoot up and continue to go ballistic for a while. Usually it ends with a massive break eventually, and all of it gets wiped out, or a huge chunk of it gets wiped out. So just know you're on borrowed time with this from a technical standpoint. I don't know what the underlying technicals or fundamentals are, although technically it doesn't matter too much in my books, because we just follow price, and the price will guide us. It'll always get us back in if it turns up and all of that stuff. But let's take a look at silver. Silver poking and starting to break to some new highs. Overall, there is a longer term picture. Actually, somebody mentioned I should look at a bigger view here. Let's drop it down to let's go to a weekly chart maybe. There is a bigger picture that points to, I think, a higher price. So silver is a really noisy chart. We've gone all the way back to the COVID lows. There's a couple angles here where we can look. We can take the COVID low, we can take this peak, we can take this low, carry it forward to see where that brings us. And that brings us pretty much to where price just had a little bit of a hiccup. It hit 100% of that move. So now we're on kind of borrowed time based on this giant pattern. Now, if we were to just look at, thinking platinum here, well, we've had a big move up and it's doing a running correction, which is dangerous, choppy. Usually it ends with a blow off phase, which could go extremely high. We just don't know where that bubble blow off phase will be, and it's followed by a big sell off. So that is something to be aware. But if we zoom in a little bit more, let's just look. I'll go to the daily chart for this pattern. If we zoom in and just stick to a high momentum move, we could potentially go with a couple different Fibonacci extensions. We could go with something more or less. We take this low, and instead of going to this bull flag, we go to this one, and that high, this low here. This points to a pretty high target up here around 45. I'm not a big fan of that, because this here is a bull flag pattern and 100% measured move. Overall, if we were to just draw where these are, here's the next one, which we've hit the 618, and the next target is at $40.80 level, which we're pushing up to. That's the most realistic one. I usually go for the most conservative and the one most likely to happen that the charts are painting. But if we can zoom into the shorter term one as well, we can say, okay, well, just based on this and this rally up and this little hiccup down here, this points us to about 42 to the upside. So those are the short-term targets for silver. And if we look at where that is, we're looking at, this is the highest one. It's about a 5-6% upside move. That's what I see. Of course, it's in that big volatile running correction I just showed you. Silver's got, it's had this running correction. As we know, silver can take the staircase up and the elevator down. It loves to base jump. So just be aware, we're on that shoot up phase where gold and silver should both do well. Now, there's about 5-6% upside based on the chart there. If we take a look at gold, Gold actually has a bigger upside potential. It has a very clear, massive bull flag that's forming through here that points to, this is just super rough, I'm not dead on drawing the lines, but up to about 4,100. And if we were to look at that percentage-wise, it's a lot more attractive at 19 or so percent than silver at a 6% move. So silver could go ballistic and shoot higher. That's what silver does. It's unpredictable. But the charts are showing the most stable play is still gold. And one of the members mentioned the other day why a lot of people don't like silver. And one of the reasons why I don't like it is because it can take forever to go up, and then it takes an elevator straight down. And it just carries a lot of risk. I just don't like to trade stuff that is like walking on glass and through a landmine. Gold, generally that doesn't happen. Percentage-wise, it's very conservative. So last but not least, I don't think I talked about this yet. I get confused which video I talked about because the first video didn't record. But anyway, if we let's just go back to the stock market and the sentiment. Typically in an uptrend, in an uptrend, we typically see these little waves, these orange bars after a little bit of a pause or pullback, and then the market pushes higher. In a downtrend, we tend to see these orange bars as a standout high, and the market drops after these. And so what is interesting is right now we actually have the markets hitting new all-time highs, and we have this our market is telling us that things are breaking down behind the scenes, and we could be actually starting a downtrend. So with our SPY trade, we're about 1% away from our next target, which I just hope we can hit so we can lock in more gains up here. And then I don't really care what happens because we're mostly going to be in cash as we'll closed out most of our SPY trade. We've already closed out our QQQ at 15% last week. And typically when the QQQ gets to this 15% target, that's when volatility picks up. That's when a multi-week or multi-month correction kicks back in. So anyways, that's it for today. We'll see how that unfolds, and we'll talk to you soon. Bye-bye.